$5.7 trillion. That's how much the global economy will lose because of Trump's tariff war. Not projected, already calculated by multiple institutions. JP Morgan just slashed global GDP growth from 2.1% to 1.4% in 9 months, the fastest economic deceleration since the 2008 financial crisis. And here's what nobody's telling you. The tariff revenue Trump promised, it's already collapsing. Peaked at $34 billion in October, dropped to $30 billion by December, a 12% collapse in just 2 months. The weapon backfired. China isn't buying American goods anymore. Imports from China dropped 25%. Mexico and Vietnam are filling the gap. American manufacturers, highest bankruptcy rate since 2010. And here's the terrifying part. We're in month 10 of a trade war that historically takes 12 to 18 months to trigger full economic crisis. The Smoot-Hawley Tariff Act of 1930 took 14 months to cause the Great Depression. We're 2 months away from that timeline, and JP Morgan just called a US recession. Not maybe, they called it. By the end of this video, you'll see exactly why this tariff war was doomed from the start, which countries are winning while America loses, and the 3 specific timeline markers that signal we're approaching economic crisis. Because there's a pattern here, a pattern that repeated in 1930, a pattern that repeated in 2018. Same mechanics, same backfire, same recession outcome, and we're watching it unfold in real time. Let me start with what actually happened. On April 2nd, 2025, Trump invoked the International Emergency Economic Powers Act, emergency powers, to impose tariffs on almost every country on Earth. He claimed persistent trade deficits constituted a national emergency, 10% baseline on all imports, 20 to 60% on specific countries. China got hit with 47.5% effective tariff rate. The European Union 30%, Canada 35%, Mexico, India, Japan all hit with double-digit tariffs. This was marketed as bringing wealth back to America, manufacturing jobs returning, trade deficits shrinking, the External Revenue Service collecting massive tariff revenues to replace income taxes. Here are the actual results. 9 months later, global GDP growth collapsed from 2.1 to 1.4%, according to JP Morgan. That's a 33% reduction in global growth. U.S. effective tariff rate peaked at 17% in April, the highest since 1935. Tariff revenue peaked at $34.2 billion in October, then dropped to $30.2 billion by December. Corporate bankruptcies in the United States hit the highest level since 2010. 84% of business leaders expressed concern about tariff impact on the economy. The S&P 500 experienced its largest daily swings in April during peak tariff volatility. Consumer confidence dropped to the lowest level since the pandemic. And here's the critical data. U.S. imports from China dropped 24.7% in the first 3 quarters of 2025. But total U.S. imports didn't drop. They shifted. Vietnam imports up, Taiwan imports up, Mexico imports up. The supply chains just rerouted around the tariffs. American consumers are still buying the same products, just paying more for them because they're routed through third countries. The tariffs didn't reduce imports, they increased costs. And American exporters? China retaliated with tariffs ranging from 10 to 42.7% on U.S. goods. American agricultural exports collapsed. Farm bankruptcies surged. Trump had to implement emergency bailouts for farmers. This isn't theory. This is documented Treasury data, JP Morgan analysis, and Congressional Budget Office reports. Now here's what they don't want you to know. This was predictable, completely predictable, because the pattern has repeated twice before in modern history. Same playbook, same backfire, same economic destruction. Let me show you the 4-stage pattern of tariff-induced recessions. Stage 1. Political pressure and protectionist response. A country faces economic anxiety, usually unemployment or trade imbalances. Politicians promise that tariffs will bring back jobs and manufacturing. The Smoot-Hawley Tariff Act of 1930 was passed during this exact political climate. Great Depression fears, unemployment rising, politicians promising to protect American workers by taxing imports. Trump's 2018 tariffs followed the same script. Rust Belt unemployment, manufacturing decline, promise to bring back American steel and auto jobs. And now 2025, same political pressure, same protectionist promise, same stage 1, stage 2, tariff implementation and immediate retaliation. The tariffs go into effect. Within weeks, foreign countries retaliate with their own tariffs on the imposing country's exports. In 1930, Canada retaliated within 1 month. European countries within 2 months. By 1931, 25 countries had implemented retaliatory tariffs against the United States. In Trump's first term, China retaliated within 3 weeks of the 2018 tariffs. European Union retaliated within 1 month. In 2025, China retaliated in March with tariffs ranging up to 42.7% on EU dairy products. Brazil, India, Japan all announced retaliatory measures. The pattern is identical. Tariffs provoke immediate counter-tariffs, and that's where the backfire begins. Stage 3. Supply chain disruption and cost increases. This is where the economic damage accelerates. Companies that relied on low-cost imports face 2 choices: pay the tariffs and raise consumer prices, or find alternative suppliers. Both options are expensive. In 1931, U.S. manufacturers saw input costs spike 30 to 50%. Many went bankrupt. Can't compete when your costs are 50% higher than foreign competitors. In 2018, American manufacturers using Chinese steel and aluminum saw costs increase 25%. Harley-Davidson moved production overseas. General Motors announced layoffs. And now in 2025, the data is worse. Effective tariff rates hit 17%, the highest in 90 years. U.S. companies using imported components saw costs explode. Many shifted production entirely out of the United States to avoid the tariffs. The tariffs didn't bring manufacturing back. They drove it away. Because if you're a manufacturer and U.S. tariffs make your inputs 40% more expensive, you move production to Vietnam or Mexico, where you can import the same components tariff-free and then export the finished product to the U.S. The tariffs incentivized offshoring, the opposite of their stated purpose. Stage 4. Economic contraction and crisis. This is where we are now. The supply chain disruptions, cost increases, and retaliatory tariffs compound into measurable economic damage. In 1931 to 1933, U.S. GDP contracted 27%. Unemployment hit 25%. The Smoot-Hawley tariffs are widely credited as a primary cause of the Great Depression's severity. In 2018 to 2019, Trump's tariffs contributed to U.S. manufacturing recession. Doesn't show up in GDP because services sector was strong, but manufacturing specifically contracted. Now, in 2025 to 2026, JP Morgan is calling a full U.S. recession, not just manufacturing, total economy. They downgraded global GDP growth by 33% in 9 months. Canada and Mexico already in recession. Europe's growth forecasts slashed, China pivoting to alternative markets. The tariffs triggered a synchronized global slowdown, and the timeline is critical. From tariff implementation to recession call, 9 to 14 months. Smoot-Hawley took 14 months. Trump's 2025 tariffs took 10 months. We're in the window right now. Now here's where it gets terrifying. We're in stage 4 right now, but most Americans don't realize it yet because the worst impacts hit businesses first, consumers second. Let me show you the evidence that this is already spiraling. JP Morgan recession call. On January 6th, 2026, JP Morgan officially called a U.S. recession. They stated business sentiment is collapsing, investment spending declining, hiring frozen. Their exact words were, "We anticipate this slide in sentiment to accelerate sharply into mid-year." Mid-year means June 2026, 5 months from now. That's not vague. That's a specific timeline. And JP Morgan doesn't call recessions lightly. They have proprietary data from millions of business accounts. They see corporate cash flows declining in real time. When they call recession, they're not guessing. They're reading the data, tariff revenue collapse. The Trump administration projected tariff revenues would hit $380 billion annually. That would fund the External Revenue Service, pay for tax cuts, maybe even fund direct rebates to citizens. Trump mentioned a $2,000 tariff dividend for every American. The actual numbers? Tariff revenue peaked at $34.2 billion in October 2025, dropped to $32.9 billion in November, dropped to $30.2 billion in December. That's a 12% decline in 2 months. Annualize that, you get maybe $280 to $300 billion for the full year. Bipartisan Policy Center estimates $288 billion. That's 24% below projections. And it's declining every month because imports are falling. When you tax something, you get less of it. Economics 101. Trump taxed imports. Imports are falling. Revenue is falling. The entire revenue model is collapsing. Corporate bankruptcies at decade high. U.S. corporate bankruptcies in 2025 reached the highest level since 2010. That's the year after the Great Financial Crisis. Companies can't absorb the tariff costs. They can't pass them to consumers without losing market share. They can't shift supply chains fast enough, so they file bankruptcy. This isn't affecting small companies only. Major retailers warned Trump in April that visible price increases and product shortages would hit within 2 weeks if tariffs stayed at peak levels. Trump blinked. He negotiated temporary truces with China and the UK, but those truces expire. The UK deal is 10% tariffs, down from higher levels. China deal is 10% for 90 days, repeatedly extended. But the underlying pressure remains. Companies are bleeding cash, foreign retaliation escalating. China didn't just impose retaliatory tariffs. They restructured their entire trade strategy. Chinese imports from the US dropped, but their imports from Brazil, Argentina, and Australia surged. China's diversifying away from American suppliers permanently. Same with Europe. EU announced they'll source soybeans from Brazil, not Iowa. Airplanes from Airbus, not Boeing. This isn't temporary. These are permanent supply chain shifts. And once those relationships are established, they don't reverse. American farmers and manufacturers are losing market share permanently. The National Farmers Union called it catastrophic. Farm income down 38% in regions heavily dependent on Chinese exports. And the bailouts Trump provided? Funded by tariff revenue, which is now declining. The bailout funding is collapsing while the damage continues. And here's the timeline that matters most. From peak tariff implementation in April 2025 to JP Morgan recession call in January 2026, 9 months. Historically, tariff-induced recessions take 12 to 18 months from implementation to peak damage. Smoot-Hawley took 14 months to full crisis. We're at month 9. That means we have 3 to 9 months until peak economic damage hits. Not years, months. And the recession JP Morgan called? That's the beginning, not the end. Recessions typically last 12 to 18 months, so we're looking at economic contraction through at least mid to late 2027. That's 18 months of pain ahead of us, starting now. So what do? First, understand that this is not political. This is economic mechanics. Tariffs have caused recessions twice in modern history. They're causing one again. Your financial decisions should reflect that reality, regardless of political preference. Reduce exposure to consumer discretionary stocks. When recessions hit, consumers cut spending on non-essentials first. Retail, restaurants, entertainment, travel. These sectors get destroyed. If you own stocks in these sectors, consider reducing exposure. Not zero, but reduce. History shows these stocks can drop 30 to 50% in recessions. Tesla, Amazon retail division, Disney, airlines, all vulnerable. The smart money has already rotated. BlackRock reduced exposure to consumer discretionary by 18% in Q4 2025. They see what's coming, increase allocation to defensive sectors, utilities, consumer staples, healthcare. These sectors hold value in recessions because people still need electricity, food, and medicine regardless of economic conditions. During the 2008 recession, utilities dropped only 12%, while the broader market dropped 57%. During the COVID crash, consumer staples dropped 15%, while the S&P dropped 34%. Defensive sectors don't prevent losses, but they reduce them significantly. And if you're in or near retirement, this matters enormously. You can't afford a 50% portfolio drop with limited time to recover. Maintain high liquidity. This is counterintuitive during inflation, but critical during recession. Cash loses 3 to 4% annually to inflation, but during recessions, assets drop 20 to 50%. Having cash means you can buy assets at discounts when panic hits. Warren Buffett increased his cash position to $325 billion in Q4 2025. Why? Because he sees the recession coming and wants capital to deploy when stocks crash. You don't need $300 billion, but having 15 to 25% of your portfolio in cash or equivalents gives you options. When the S&P was down 57% in March 2009, people with cash bought stocks that subsequently tripled. That asymmetric opportunity only exists if you have liquidity. Hedge with commodities and gold. Recessions typically hurt financial assets, but commodities, especially gold, tend to hold value or increase during monetary crisis. Gold increased 130% from 2008 to 2012 during the last major financial crisis. Not because gold produces income, but because it's a safe haven when paper assets are collapsing. Consider 5 to 10% allocation to gold or gold ETFs. Not speculation, insurance, and energy commodities if you believe global supply chains will remain disrupted. Oil and natural gas dropped during COVID, but recovered within 18 months. Long-term energy demand increases. Short-term recessions hurt. But a small allocation hedges inflation risk and currency risk simultaneously. Reduce personal leverage immediately. If you have high-interest consumer debt, pay it down aggressively. If you have variable rate debt, refinance to fixed before rates spike further in response to recession. The Federal Reserve will likely cut rates during recession, but corporate and consumer credit spreads will widen. That means even if the Fed funds rate drops, your actual borrowing costs might not. Companies with high debt loads are the first to go bankrupt in recessions. Individuals with high leverage face the same pressure. Get lean, reduce fixed costs, increase flexibility, invest in skills and alternative income streams. Your job is at risk in recession. Maybe not immediately, but unemployment typically rises 3 to 5 percentage points. From 4% to 7 or 9%. That's millions of layoffs. If you're in a vulnerable sector, consumer discretionary, retail, hospitality, start building alternative income now. Consulting, freelancing, side businesses. Diversify your income, just like you diversify investments. Human capital is the most underrated asset, and it's the one asset that survives every crash. Position geographically and tax efficiently. If you're in a state with high taxes and economic vulnerability, consider whether a move makes sense. Texas, Florida, Tennessee, no state income tax, growing economies. If you're staying, at least structure assets tax efficiently. Max out retirement accounts. Use tax loss harvesting. Every percentage point you save on taxes is capital you keep during recession. This isn't about avoiding civic duty. This is about surviving economic contraction when government spending will increase and tax rates may follow. This is not financial advice. I'm describing historical patterns and logical responses to recession risk. But the pattern is undeniable. Tariffs caused recessions in 1930 and 2018. They're causing one now. What you do with that information is your decision. The pattern doesn't wait. $5.7 trillion in global GDP already lost. JP Morgan called the recession. Corporate bankruptcies at decade highs, tariff revenue collapsing, farm income down 38%. And we're only 9 months into a pattern that historically takes 14 months to peak. That means 3 to 5 months until maximum economic pain hits. Think about everyone who didn't see 2008 coming. They thought housing prices would rise forever. They thought banks were safe. They thought their portfolios were diversified. Then Lehman failed, and within 6 weeks, trillions in wealth evaporated. Those people weren't stupid. They just didn't understand the pattern. They didn't see subprime mortgage defaults as a systemic warning. They didn't understand how leverage and contagion work. They were blindsided. Now compare that to the people who did see it coming. Michael Burry recognized the housing bubble in 2005, 3 years before peak crisis. He positioned accordingly, made billions, while others lost everything. John Paulson saw the subprime crisis in 2006, positioned accordingly, made $15 billion in 2007 alone. The difference wasn't intelligence or luck. It was pattern recognition and action. They saw the same data everyone else saw, but they understood what it meant, and they acted before the crowd panicked. You're in the same position now. The tariff war is 9 months old. JP Morgan just called recession. Bankruptcies are spiking. Revenue is collapsing. All the stage 4 signals are present. The question is, will you act or will you hope it blows over? Will you reduce exposure now while markets are relatively calm, or will you wait until panic selling drives everything down 30 to 50%? Will you increase liquidity before the rush or after credit markets freeze? Here's what I know. Smart money already moved. BlackRock reduced consumer discretionary exposure. Warren Buffett's sitting on $325 billion in cash. JP Morgan issued recession warnings to institutional clients months before going public. The hedge funds and family offices, with billions in assets and teams of analysts, they're positioned. They see the pattern. They know stage 4 is here, and they moved before retail investors understood what was happening. That's not conspiracy. That's just how markets work. Insiders move first, institutions move second, retail moves last, and by the time retail panics, the opportunity to position is gone. So here's what I want you to do. If this video helped you understand the pattern, hit subscribe and turn on notifications, because the next video is going to reveal the 3 specific sectors that always get destroyed first in tariff-induced recessions, the exact historical timelines from 9 other tariff crises, and which assets outperformed during the 1930 Great Depression. That's not speculation. That's documented data from 9 decades of economic history. You need to see this before the recession deepens. Comment below and tell me, are you positioned? Have you reduced exposure? Are you maintaining liquidity? I want to know where you are in your preparation. And if this video gave you actionable insights, give it a like, because YouTube suppresses financial content that contradicts mainstream optimism, and your engagement helps this reach people who need to see it before it's too late. The tariff bomb already exploded, $5.7 trillion in losses. Recession called. We're at month 9 of a 14-month pattern. You have maybe 3 to 5 months before peak crisis. The question is, what will you do with that time?